In today's video, we're going to shed some light on the trickiest variable in Roth conversion planning. We're going to be talking about Medicare's IRMAA. Now, because nearly every retiree will be using the Medicare system, this is a variable you cannot afford to get wrong. Let's get into it. Now, for those that don't know what IRMAA is a Medicare mandate that if you show too much income, you will have an increased premium when it comes to your Part B as well as Part D expenses. Now, IRMAA is something that you need to be thinking about as soon as you turn age 63. Now, for some of you, that might be puzzling because you won't enter the Medicare system until 65. But IRMAA is a 2-year look back. And so the income that you show at 63 will determine the Medicare premiums you pay at 65. Now, IRMAA is based off your modified adjusted gross income. This adds back in things like tax-exempt interest from muni bonds. And you aren't able to take things like the standard deduction from this modified adjusted gross income number. It's also very important to know that IRMAA is a tax cliff, meaning that if you go $1 over a given IRMAA threshold, you will have the full IRMAA expense because of that. It doesn't matter if you're $10,000 over this IRMAA threshold zone or if you're $1 over. You will have the same expense either way. You fall off of this tax cliff. Now, we talk about IRMAA quite a bit on this channel, and many of us understand IRMAA at the very least a surface level. But when we need to start adding this in as a variable to Roth conversion planning, we start finding out that there's much more below the surface that we need to be considering. Now, in this video today, we're going to shed some light on what is below the surface. But before getting into that, let's first cover a very quick foundational building block when it comes to Roth conversion planning. How do we actually know whether a Roth conversion makes sense? Well, we can really simplify this down into considering two important variables. What is the tax rate we are paying today versus what is the tax rate we are trying to avoid down the road? So for instance, if we perform a Roth conversion today, we are paying taxes on that money today to never have it be taxed again. So if we didn't perform that Roth conversion and we took that money out slowly over time, or were forced to take that money out in the form of required minimum distributions, what is the tax rate that we would be paying down the road? Now, when we don't have any other tax hurdles that we're trying to include into this Roth conversion analysis, things are relatively simple. We compare federal and state taxes today versus federal and state taxes down the road. But what happens when we start looking at given tax hurdles like IRMAA, where we might be subject to IRMAA right now if we start converting too heavily, and we also might be subject down the road to things like IRMAA due to required minimum distributions, pushing our income up high enough that we then have those Medicare penalties down the road. Well, we want to translate all dollar expenses into a tax rate. And so let me give you an example for how we would do this with IRMAA. Let's look at the first IRMAA threshold zone, and let's look at a married couple using 2023 IRMAA numbers. And so this would be 2023 IRMAA based on 2021 income. And so the first IRMAA threshold for a married couple would come at $194,000 of modified adjusted gross income. Now, this IRMAA threshold rises all the way up to $246,000. So no matter where you fall within this zone, you are going to have the same IRMAA expense. This happens to be an added $1,874.40. And so what we want to do here is we want to try to use as much of this zone as possible. We wouldn't want to just show $1 over this IRMAA zone because we'd show $1 over this threshold and we'd have an almost $1,900 expense because of this. And so we'd want to use this full IRMAA zone. We can see that there's $52,000 worth of room within this IRMAA zone. And so what we'd want to do is bring our income up all the way up to around $246,000 worth of income, and we would look at what is our added expense rate for the added income that we are able to take, or able to convert, if you will. And so on the bottom half of the screen, I have some simple math showing what would happen if we perfectly maxed out this IRMAA zone. We would have about $1,900 worth of Part B and Part D expenses, divided by the $52,000 worth of extra room that we have by pushing through this IRMAA zone, and we would have an added marginal tax rate of 3.6%. We then want to take this one step further. We'd want to look at the tax rate we are paying on the conversion and then add in the marginal tax rate we are paying based on IRMAA. And so let's say we were paying a 24% effective tax rate on the conversion. We then add in the 3.6% added tax rate due to IRMAA, and we'd find that we're paying an effective 27.6% tax rate on that Roth conversion. And so does it make sense to pay 27.6% today? And are we going to avoid something higher than that down the road? Now, this exercise is fairly simple and straightforward, but this is only looking at if we perfectly maximize these IRMAA thresholds. And this is where the tricky part of IRMAA planning comes in. The reason that IRMAA is a 2-year look back is because the government will adjust IRMAA to inflation on an ongoing basis, Big picture, this is a positive thing versus not being adjusted to inflation. But because of this, they need to look at inflation over a period of time and then adjust IRMAA at some point in the future. And this is where a lot of the trickiness around IRMAA lies, because we don't yet know the brackets we're planning for yet. For instance, on the screen I have the IRMAA determination periods, basically the period of time that they look at inflation over in order to determine the future IRMAA brackets. So for instance, to determine the 2023 IRMAA brackets, they looked at September 2021 inflation to August 2022 inflation. And so here's the difficult part when it comes to IRMAA. If we're sitting here at the end of 2022, we need to be planning for 2024 IRMAA brackets. But as you'll see on the screen, the 2024 IRMAA brackets are determined by inflation from September 2022 to August 2023. And so we need to finalize a conversion by the end of 2022, but we don't yet know what the inflation is going to look like from January 2023 to August of 2023 in order to determine the IRMAA brackets of 2024. Now, we recently just recorded a video talking about how to calculate IRMAA the right way, despite not having all of the variables that we need. I'll link to that video at the end of this video, but the reason this creates such a cumbersome Roth conversion calculation is in the previous slide, I showed the importance of fully maxing out an IRMAA zone. Well, if we don't yet know where those IRMAA thresholds fall, how can we actually fully max it out? Now, previously, when I translated IRMAA to a tax rate, I showed as if we were fully maxing out that given IRMAA zone. What happens if we're not exactly able to predict where that threshold lies? Well, then we might be paying a higher tax rate because of this. So on the screen now, what I'm showing is within that first IRMAA threshold based on 2023 numbers. If we didn't fully max out that given zone, now where would we adjust that added marginal tax rate due to IRMAA? So remember that IRMAA threshold starts at $194,000. What happens if we only went $1,000 over that IRMAA zone? And our modified adjusted gross income, as you can see on the screen, on the left-hand side of the screen, is at $195,000. Well, then we'd be paying an almost $1,900 expense for only being able to show an extra $1,000 worth of income. That would translate to about 187% marginal tax rate. Now on the screen, I have it highlighted in yellow every $10,000 increment as you moved and fully maximized that IRMAA threshold. And as you can see, the more income that we add within this zone, the lower the marginal tax rate will be. Again, this makes sense as we already discussed. So hopefully this makes sense. All I'm showing here is what your marginal tax rate would be if you mismanaged IRMAA zone. And so the added tax rate you pay on IRMAA is based on your ability to estimate and fill IRMAA zones. Now understand, this isn't going to be a perfect science. If inflation starts running hotter than we had previously expected, it will be much more difficult to fully maximize an IRMAA zone. There are going to be some mistakes made here, but we want to try to get as much as we can out of these given zones. Now in the next slide, all I want to do is take the same graph, but now let's zoom in on the last $20,000 worth of room you had within this threshold zone. And as you can see here, your rate, if you were $20,000 short of maxing out that zone, would be around 6%, and it finally falls towards 3.6% if you fully and perfectly maxed out this zone. Now again, it is worth noting that in the same way that we need to be planning for IRMAA and the added tax rate now when we're performing Roth conversions, also understand that you don't have as much choice when it comes to a required minimum distribution. And so later in retirement, if you have an RMD that pushes you just slightly above an IRMAA zone, if you don't do anything else to maximize that IRMAA zone by filling in extra income via distributions or Roth conversions, you will have a much higher tax rate that you're trying to avoid as well down the road. And so again, we're not only comparing IRMAA today, but we're also thinking about IRMAA and RMDs down the road as well. And this is where we find a balancing act when it comes to IRMAA. We generally want to be conservative to avoid falling off the next IRMAA cliff. But also on the flip side, as we've talked about in this video, we want to be aggressive enough that we're fully filling up this zone. This leads to, well, the trickiest variable when it comes to Roth conversion planning. I hope you found this video insightful and it gave you a little bit more knowledge to start planning around this tricky variable. Now, as I hit on multiple times throughout this video, the importance of accurately estimating these IRMAA thresholds down the road cannot be understated. Well, I just recently recorded a video that shows you exactly how to do this, how to plan for IRMAA the right way. I'll link to this video right here. Always remember, you don't need more money, you need a better plan. Thanks for watching. We'll see you in the next video.